Series of educational webinars designed to enlighten you on a variety of investment and trading ideas, demonstrate the features and tools that Barchart provides related to these concepts, and offer some traders insight to help you make a more informed decision. Today's subject, Bollinger Bands explained, winning option strategies for breakouts and reversals. Now, Bollinger Bands are one of the most widely used volatility indicators, providing traders with a framework to identify both breakout opportunities and potential reversals. It's built around a 20-day moving average, and the bands extend out to standard deviations above and below price, creating a dynamic channel that reflects volatility. Now, when price moves beyond those boundaries, it often signals a strong trend is in progress. Yet, as every trend carries the bend at the end, Bollinger Bands can also weigh in on the probability of a mean reversion. Now, Barchart's investment technical idea, breakouts and reversal page, identifies candidates that are exhibiting volatility expansion and contraction. And armed with this knowledge, traders can employ structured, risk-defined option strategies that gain from both trend recognition and changing volatility. Hello, everyone. My name is John Rowland, Barchart's Senior Market Strategist. And in today's session, I'm going to introduce you to Barchart's new Breakout and Reversal Screener. I'm going to break down its components. We're going to decipher the distinctions between continuation and exhaustion, and offer some simple guidelines on which option strategies will optimize the changes in volatility that Bollinger Bands recognize. Now, before we stretch the bands of volatility, please welcome our moderator and Barchart's project director, Jean Baker. Hello, Jean.
Happy Wednesday, John. How are you doing?
Happy hump day. I'm doing well. And yourself?
Good, thank you. Yeah, these new screeners that you're going to be presenting today, we're pretty excited about them. They're newer additions to the website, and I'm sure you're going to be covering them wonderfully for our users today. So
yeah, we've been working hard on them, and I think folks are going to really enjoy them because I think they kind of boil down. It makes it easy to find these candidates that we're going to learn how to discover today. So, you ready to jump into it?
Yes, let's get going.
All right, here we go. Just a reminder, today's session is for educational purposes only, and decisions to buy, sell, or hold or trade securities, commodities, or any other investment involves risk. Investment made on the advice of a qualified financial professional, and under no circumstances shall we be liable for any damages or losses that occur as a result of any trading or investment activity that you or anyone else engages in based on any information or material you receive through barchart.com and our services. Okay, so here's where Gene's talking about. We're doing a lot of updating on our website. So we come under here where it says investing and these technical ideas. And we've recently done a few webinars on some of these, but here's the one we're talking about today: breakouts and reversals. So first, let's start by saying this, that I'm going to explain that for today's session is we're going to do an examination of Bollinger Band setups and potential probabilities. And there's going to be a focus on the option strategies that could be profitable from these expected outcomes. Now, if you're interested in a deeper interpretation of the analysis of Bollinger Bands, then I would recommend that you would click onto this link here, which will take you to one of my previous webinars. And this goes beyond the first paragraph description here. But boil it down, Bollinger Bands are a 2 standard deviation set of bands around a 20-day mean, a mean anchor. And for our page here, our default settings or our default views, we have last change, percentage change, 5-day percentage change, 20-day moving average, percentage 20-day moving average of price, and the Bollinger Band percentage. So the percentage indicators here or filters here, you will notice that there are greens, which means that you are above a certain percentage or above a value, or it's up, and red meaning that is below or it could be down. Now, working here at bullish movers, these would be those that are doing well or are in a bullish move. So I see a lot of green here. If I go to, let's say, downside breakouts, notice how you see a lot of red. Now, again, this idea under the Bollinger Band percentage is an expression of where the last price is located in proximity to the Bollinger Bands. Again, with the upper band representing 100% and the lower band representing 0%. Now, just for reference, the mean, the 20-day moving average, would be represented by a value of 50. So again, for our bearish movers here, we can see that we have some that are negative 3%, negative 30%, which means that it is below the lower band, and in this case by 30% of the Bollinger Band. All right, so let's just go back to some slides here for a moment, and let's kind of build this out. So the core indicators inside the breakout and reversal page are our 20-day moving average, our anchor mean, our lower and upper bands, our standard deviations, and now that is going to help us define our Bollinger Band percentage, and then where is that relative price positioning versus our bands. Now the page is divided into 6 segments or categories, and they are bullish movers. These are stocks that are above the upper band. Now, bearish movers, those ones that are below the lower band. Upside breakouts, those are the ones that are above the upper band, but are up above the upper band as of today. Downside breakouts below the lower band, and again, below the lower band today. Upside reversals, these are stocks that have been above the upper band, but now are below the upper band and could be potential reversion candidates. Downside reversals, where they were below the lower band, but now are above the lower band. Now, there are some additional features or filters inside of this page. One is we look at something called the 9-day average daily range percentage. And what this really does is it eliminates a lot of wonky stocks, which maybe could have been moved after a split or a takeover or a merger, or just don't have a lot of price movement to them. The other thing we're going to look at is market cap, and we're going to use a market cap valuation of $3 billion. And again, this does eliminate a lot of small and mid cap stocks. Could there still be opportunities based on these concepts? Yeah, but what we're really looking for is this is going to ensure that we'll have tradable volatility. Now, one thing that we don't filter for is options, because you could trade some of these candidates based on just their outrights. In other words, buy or sell the stock. But there might be those candidates that might have options or might not have options. And those that have options might not lack the liquidity to trade. And we'll look at that in a moment. So market analysis with the screener. So how are we going to kind of use this? Well, first of all, we're going to look at breakouts. And we're going to put ourselves in the right set of mind based on these designations. So breakouts and movers are candidates that have powerful momentum. which has placed price beyond that stock's two standard deviation above or below. Now, movers could be multiple days, and breakouts, again, will occur just today. Now, the question comes to us is, how do we interpret continuation momentum versus potential exhaustion? Now, in every situation is unique with different markets, but what I'm going to do here is I'm going to pull up Tesla, because I feel like Tesla, I'm going to give you a lot of kind of guidelines, and I think Tesla has a lot of great examples over the last year or so. So first of all, before we start, just give you some kind of reference here, is that on my Tesla chart here, I have added two indicators. One is Bollinger Bands, which would be found on an overlay study. There you can see right there. And then I've added a volume, which will be a standalone study. And, again, one of the benefits of being a Barchart subscription member is that you can create multiple templates, and this would be a great way to, create a template that allows you to do this analysis. All right, so let's talk about some of these ideas of a continuation versus a exhaustion. So again, these are just general guidelines. So start with bandwidth. So narrow bands that flare out can signify the start of a continuation move. And you can see for Tesla here, we're getting that flare out. Let's make this a little bit wider, right? You can see where our bands were kind of flat and flare out. That is a really good indication you're going to get a continuation of price movement. And you can see this again back here, right? Our bands had come in, and then boom, nice turnout, right? Flare out, and then a continuation of price movement. Now, widened bands reflect extreme volatility and warn of reversions or mean reversions. So you can see how wide our bands are here as compared to where bands have been in the past. And that would be a sign that there was a probability that we're going to revert back to that moving average. Now, those of you who are familiar with Bollinger Bands and use Bollinger Bands, I just want to let you know that under technical analysis, we do have a technical analysis that's based on band width, okay? If you wanted to do that analysis. All right. Another way we can determine expansion and exhaustion is that candles are bars that carry along. In other words, hug or are close or on or about the bands. That reflects continuation. Again, let's look at Tesla here, right? We're carrying along the bands. We're not really going far outside them. We're kind of bumping up against them. That is a sign of continuation. Again, you can see here, we are going outside the bands briefly, but we're very close to the bands. So again, if we think about our screener here, that would be that percentage Bollinger Bands. For an upside, let's say we want to be near that 100% and not far away, let's say 125 or 130%. That could be more of an exhaustion. Now, exhaustion, it typically is found or preceded by a whole candle or bar outside the band, and you can see two examples here. Now, we didn't get a full mean reversion here, but you can see a whole candle outside the band is typically a sign of exhaustion, and you can see that we had a multiple day of a bit of a correction. Here, again, another whole candle outside of our Bollinger Bands and multiple days that took us to a mean reversion. Now, what does happen sometimes in these exhaustion patterns where you have wide bandwidths and you do get an outside candle is you get a snapback not only to the mean, but a lot of times it'll run from the one band to the opposing band. So that's something you can look for. But we're going to just set up our trades based on our mean reversion. Narrowing range bands, where price has been range bound, right? Narrow bands. So what we're going to look for on these ones is a lack of price confirmation or validation. And one way we can do that is by looking at volume. So you can notice here, let me make this again, let's look a little bit bigger. So we got a Bollinger Band piercing, right? That could be an indication of increased volatility and maybe a breakout scenario. But notice our volume, right? Not only, well, maybe a little bit of a volume increase here, but you're going to see very quickly volume dropped out. Volume is not validating the price movement, not validating the breakout above the Bollinger Band. And another tool that I use, and those of you who are disciples of a lot of the webinars that I do, is we can look at something called average true range, which is found in our technical analysis section of any individual stock or a futures market. And what we can do here is we look at average true range as a qualifier for our breakouts. And the rule that I use is 1.5 times. So just again, I'm just going to do this in terms of guidelines. So let's say Tesla here is our average true range is above 14. So 1.5 times that, that's 21. So when we look at it a breakout, we want to see a breakout of about 21 points. And again, if I go back to my chart here, obviously we didn't get that follow through. But now let's look at what has happened of recent, right? Here is that breakout. Now I put a line here, 357.38, and we said 21, so that would be 378 approximately. And you can see that here this candle did give us that qualifying ATR breakout confirmation. And again, notice, rising volume, right? Rising volume. Volume is validating our price action. All right, so reversals take in the same guidance. The key difference being that it's a reversal of previous price action, where price action pierces outside but quickly returns. And now the key concept here will be closes inside of the bands. So you could see price fluctuate on a daily basis. We really want to see those closes inside of the band. Again, we can look at technical indicators like momentum oscillators, stochastics, and RSIs that are in overbought or oversold conditions. Again, a lack of ATR movement could be a sign of an exhaustion or reversal. But volume, as I said, could validate price. If we see volume peaking or a singularity, in other words, a one-day event, that can enhance exhaustions or these reversals. And there's a great example here. Here we can see Tesla prices falling pretty precipitously. We get a big candle, probably a lot of momentum here, and we get a close outside of our range. Typically, we would say, hey, this is something that we would be concerned about, that maybe we are seeing the beginning of a new price action, a new trend, right? But price has probably fallen too fast. And what we see here in terms of volume is that it's a huge amount of volume on a one-day event. And what has happened after that? Price closes inside the band and volume drops off significantly. So this was a singular event that is telling us that there's probably an exhaustion to whatever this price movement was. So something to watch for on these singularity events. Now, there's not an example here on Tesla, but if you see a bandwidth that is consistent, in other words, let's say rising or falling, that has a consistent width, and you see a lot of wicks or shadows of our candlesticks that are piercing outside of our bands, then that could be a sign that you're getting closer to exhaustion. Excuse me. Another clarifying characteristic is a cluster of technical analysis. And I kind of hinted at this, RSI stochastics, ADX, MACDs, depending on how you define overbought or oversold. But we could also look at something called sector groups for breakouts and reversals. And what we're talking about here is when we see multiple stocks in the same sector, this could be the algorithms picking up on some fundamental news, some kind of corporate news. Maybe it's the earnings in one is affecting the others. So let's go back to our reversal page and excuse me again. So for instance, here we're looking at bullish movers, right? These are ones that have been outside the upper Bollinger Band. And again, one of the benefits of being a subscribed member is you can create your own custom views. And I have one custom view here that is called comparative that looks at industry groupings. And so I'm going to sort by that. And what do we see? Well, notice how we have a cluster of stocks that are in the oil exploration, right? Exploration. We have some biomedicals. I think there's another cluster down here based on internet software and services. So what you can find is, as a qualifier of a reversal or a breakout, is if you have multiple stocks in that industry group or that sector. And that could be a dynamic shift or a fundamental shift in that market, and that the algorithms are picking it up and that they're buying all the stocks or a majority of those stocks in that particular sector. Okay, so that's something to keep in mind. All right, so what I said was, talking about reversals, same ideas, and we're looking for that snapback. And I pointed out a couple ideas about identifying volatility, talking about stretching those Bollinger Bands, where price goes outside the band, but it doesn't stay outside there for a long period of time, and identifying those sectors and clusters. Okay, so now we have the basics of ideas of what we're kind of looking at or what we're looking for. And so what we want to do is now, how do we pair this with our option strategies? So for breakouts or expanding volatilities, those would be our movers. We're going to look to buy volatility. We believe that volatility is going to increase, right? And so ways that we can go long volatility is through straddles, strangles, and debit spreads. I could buy just a singular like long call or a long put. Now, if I'm thinking of something that is maybe more directional and I want to play it from that perspective, then, something like a debit spread, a vertical debit spread, for instance, in this case, an upside breakout, we're going to go long call spread, a bull call spread to try to capture that trend. Reversals in contracting volatility, right? We're going to go short volatility, sell volatility. So again, credit spreads, iron condors would be options strategies. And then again, if I'm looking at for maybe a mean reversion or a correction in a market, I could also look at selling, for instance, a vertical spread. But in this case, this is a credit vertical spread. So a downside reversal where price has fallen outside of a Bollinger Band, and now it's come back inside. That would be a candidate for mean reversion. So a great option strategy would be the bull put credit spread for that mean reversion. Now, I can also look at movers, for instance, in these reversals and contractions of volatility that are exhibiting that exhaustion characteristics, some of the ones that we just kind of talked about, right? But the idea is, again, collecting premium based on a volatility expansion. All right. So again, matching our strategy to not just only direction, but also volatilities. Now, what we could do and what we will do is we could look at implied volatility. Now, implied volatility could give us some clues and guidance to the proper strategy to match our perceived outcome. And the other thing that we might want to think about when we're choosing our strategy is a trader's preference here. And that is managing our risk to reward. Now, we could look at that by picking a very defined risk spread, or we could do something like naked positions, long or short calls. Now, I think this is more applicable to credit and premium collecting than it is for debit spreads. But think about this. What we're talking about is the trade-off is that defined risk will also limit our profits. Whereas let's say a naked position, we might have unlimited risk and maybe have limited profit. Again, this is more of a trader's preference. Okay. All right. So this is a chart that I made for you folks for a map, basically to help you distinguish the different types and combinations of volatility, outcomes, and strategies. Now, remember, all of our slides are attached to our webinar, and I'll show you that before we end our session today. And then you can use this as a reference or a guide for helping you to decide what strategy will better fit your risk reward and your risk tolerance. All right, and we're going to look at some distinct examples here in a moment. We'll look at upside breakouts, upside reversals, and downside reversals. But before we get to that, I want to talk about this idea of conservative versus aggressive in terms of the style of options trader that I am. So delta is going to be a very important part of our process, delta in terms of strike selections. But those of us who trade options understand that delta also equals the in the money probability. In other words, the probability that price is going to finish near that strike. Now, for a conservative buyer, in other words, I'm buying volatility or I'm buying a directional spread, I want to pick at the money deltas, where my delta is probably somewhere between 40 to 55, slightly in the money, maybe slightly out of the money, but right around at money. Again, that higher probability, 40% chance, 55% chance that strike is going to finish in the money. Aggressive buyers, right, somebody who's very confident in their price movement, they might pick a out of the money delta, something like 10 to 25%. Now that will lower the cost of that option, but there's also a lower probability that strike will finish in the money, but it also will increase the potential for profits. Conservative volatility sellers or directional sellers, we're going to look at short strike deltas of, let's say, less than 20, somewhere in that 20 to 10. Aggressive, again, very confident in our direction or confident in the volatility. A contraction, we're going to short strike deltas in that 25 to 45 area. Now, these are individual deltas, but what we're going to do is we're going to look at this from a concept of net delta as well. So wait for that in a moment. In terms of days to expiration, again, a guidelines, if I feel like this is an immediate movement, right, that we're seeing volatility, blow up, again, could be a news story or something, and I'm anticipating multiple days in the next 3 or 4 days, then I'm going to look for those short DTEs. Again, this is going to, in terms of options, I'm going to get that high gamma effect to the options. Now, if I'm unsure of the timing, or I want to reduce the theta risk, in other words, the theta decay, for instance, let's say I'm looking at one of these candidates where we see a lot of small candles that are kind of just carrying along our Bollinger Bands that are continuing to increase or expand, then, I want to let that trend play out, right? So I might look at a more of a medium to long-term DT, 30 to 90 days. Now, that is very conservative. Now, I will point out in this kind of scenario is you might set up a trade where it will become profitable, but there might be a lower expectation or probability of getting the max profit. We'll get some kind of profit, but we might not get that max profit. All right. Another thought in terms of aggressive and conservative ideas is, where are we going to put our strikes relative to our bands? Again, if I'm buying volatility and I want to place a long out of the money strikes at or just outside the bands for my strangles, or at the money for my straddles. If I'm doing directionals, right, I want my long strikes just beyond the breakout band. That's an important concept if I'm conservative. But what I might do is use those vertical spreads to not only cap my risk exposure, but it does also cap my profitability. If I'm selling premiums, I'm going to place my short strikes near the band edge. That is conservative, maybe a little bit outside of it. And if I'm aggressive or I'm very confident in the price movement, then I'm going to be looking to sell premiums of strikes that are inside our bands, right? We're talking about our mean reversions, higher credit, but also higher risk. And then we'll set, if I'm doing those vertical spreads, I'll be setting my wings or my iron condors outside of those bands. Okay. All right. Let's go to upside breakouts. All right, let's start there. And so the first thing that we're going to do here is, again, we need to eliminate some of the candidates. Now, we know a lot of these are high, good market cap candidates, and we know that they have price movement. But what we don't know is, do they have options, and then are their options tradable? So the first thing we're going to do is we're going to come in here and under select, I can just type in the word options, but I just want to show you where you can find it here. It says options overview. And does that stock have options? And the other thing I'm going to do is I'm going to look at total volume. Now, what I want to do is I want to see a consistent amount of volume on a daily basis over a month period. Now, I'm not going to put a value in this one. We're just going to use this as a comparison in terms of our potential candidates. So again, we're filtering on our Bollinger Band upside breakouts, right? Those that are just giving us a new buy signal or breaking out above the upper band. And we're looking at our volume and our options opportunities. So notice that when I did this, my filter also brings up the description. That's because when I set the filter, I do put up here the industry and the SIC industry. So again, something that you can keep in mind. So what I'm going to do here is these are all ones that have options. So let's sort by options volume. And we have a lot of candidates, but in terms of volume candidates, maybe our cutoff here might be about 10,000 volume. And I'm looking at beyond, let's say, Zillow, we don't have many candidates to choose from in terms of options viability. But let's look at the ones that we do have. So what do we decided we're going to do? Well, upside breakouts, right? What were some of those guidelines? Well, first of all, we want to find narrow bands. Again, narrow bands where we see price breaking out of, and also maybe structure. Maybe you're seeing the market making a new monthly high, a new weekly high. You want to see price piercing above, but we also want to find that volume and that ATR movement. Again, we could talk about sector clusters, right, or other technical indicators. And for this example, what we're going to look at is our bull call vertical spread. So what I've done here is I'm going to go to flip charts, and I've set my default on my flip chart, so you can go into your site preferences. And for this demonstration, I'm going to have my flip charts that have Bollinger Bands on it. But again, if you don't know where you can find that, you can just go here and under indicators and add that to your flip charts. Excuse me. Okay, so what do we want to find? We want to find narrow bands where price is breaking out. Now, in this case here, this one, NEO, it does look like it's breaking out. I do see a lot of things that I like about this one, right? We see an upsloping 20-day moving average. That is something that, a preference that I kind of look for, right? Because it's already telling me that this market is already in a positive or upsloping trend. But, bands here are probably a little bit wide for me, right? Considering where we can see where past narrow bands are. Now, if I go to, let's say, Pindu, which is the next one, right? This one works a little bit better for me because it is more of a narrower band breakout, and the bands are starting to turn out. Plus, I can see that price has broken above structure to previous highs. And again, let's look at our technical analysis, right? Yesterday's closing price was around 129. And if we go to more data here under technical analysis, I can see the ATR for this one is about $3.70. So again, a 1.5 times puts us around $5.50. So above 129 at $5.50 puts us at around 134.50. Now we're not there yet, but we're pretty damn close to it. So this would be a good candidate. Now, again, there's not a lot of great candidates. I went and looked through a lot of these. So this is really the best of the examples that I'm going to show you. But I think you can understand the basic ideas. Again, we could also add a volume as an indicator. And apply that. Now, one of the things that you need to understand is that if we're in real time, our volume runs a little bit behind. Turn it off real time, and you're going to get a more updated volume. This is the basic how we collect our data, where we get our data, price data from. But then if you're looking at this at the end of the day, you're going to see that volume. But you can see that, what are we seeing? Volume is increasing, validating that potential price action. Okay. All right, so let's now break this trade down. So we have a breakout. Where's our breakout? Looks like it's around 130. So what we said is that if I am aggressive or conservative, where do I want to pick my strike? Maybe around the 130. Maybe I'm going to wait for that confirmational ATR, 135. And then how do I select my opposing wing, or my target, so to speak, my target strike? So one technique you can use is you can look at the bandwidth before the breakout. In this case, we can see, if we look up here, the red being the upper and the green being the lower, it's a little bit more than $10. Looks like it's about $11.50. So if I'm using a 130 call or a 135 call, what's going to be my target? Well, I want to use one bandwidth. And so that would be about 10 points. So 130 plus 10 would be 140. So I'm going to look at the 130 call 140 call spread or the 135 140 call spread. So let's go to Pindu, and I'm down now under vertical spreads. We're looking at the bull call spread. Again, I don't know if this is going to be a quick volatility event or it's going to be carry, but anytime I'm paying for options or I'm buying for volatility, I really want to have some time play out. So there is a balance that I need to, more time going to be more expensive, but at least 30 days I think is definitely something that I can afford. So what do we say? 130, 135, 130, 140, 135, 140. And there we go. 130, 140, where our maximum profit would be $5.70, and our maximum loss could be a potential of $4.30, right? I think that would be more conservative, right? Because we're already in the money, right? But look at our delta here. This is our net delta. And again, one of the things that I said to you is, on a conservative basis, or when I start looking at these spreads, there's kind of this sweet spot that I'm going to look for, and that is somewhere between a net delta of 25 and 35. And we can see that the 130, 140 falls right inside of that range. If we look at the 135, 140, now think about this. We're waiting for price to go higher, in other words, to get profit, but we're capping our profitability. So this is actually a little bit more aggressive, right? But notice what happens, that we get paid for that aggressiveness, right? Our cost goes a lot lower. Now our reward is capped, it's a little bit lower based on the 130, 140, but the risk to reward is much better. Now notice that our delta here is below that 25. Again, a lower probability of this trade playing out. Again, you need to be very confident in what your analysis is. So here's where we kind of look at delta, and we also look at that risk reward ratio. All right. Okay, so let's go back to our breakout and reversals. And now we're going to talk about upside reversals. Now, upside reversals are those that have gone outside the Bollinger Bands and then are now coming back in. Again, most likely what we're going to do on this one is we're going to look for credit spreads, right? We're going to probably do some kind of a bear call spread. Okay, again, I'm going to have to screen on these. Again, the things that I need to screen are my options, my options volume, and then one of the things I've mentioned to you before is volatility, right? So we could look at options from the lens of volatility. So I'm going to come back in here and look at rank. Now, if I choose rank, and I just choose rank as the singular here, rank is based on where is volatility today based on what has happened over the last month, the last year. So ideally, we want to find those candidates that have a high implied volatility rank over the last year. Why? Because then the premiums are going to be more lofty or more bloated, and that means there'll be a lot more credit for us to get. But that might not always be the opportunity for us in terms of Bollinger Bands if we can't find those candidates where the bandwidth is super wide. Maybe we're seeing one of those ones where we're in range bound, right? But if we look at implied volatility from, well, let's add rank, and I'm not going to put a value in this. I'm going to just for demonstration purposes. But let's look at implied volatility where volatility ranks over the last month and add that. But here what we're going to do is say, we want to see those candidates whose implied volatility is elevated over the last month. And notice what we see here. Well, let's sort by implied volatility. We have a lot of candidates here where in the last month our implied volatility is at 100%. In other words, in the last month, we have seen an increase in volatility, and now these might be better candidates. Now, if we look at this in terms from a rank perspective, notice a lot of these do have low rankings. Now, what we probably want to do ideally for great scenarios, we want to find ranks that are probably above 50 or even closer to that 100%. And I don't see any of those candidates currently here. I do see down here QuantumScape, and maybe you can look at that later, where your rank is, a monthly rank is around 90 and our daily rank is around 84. But let's go back to our charts. So what do we want to look for, right? We're kind of opposite of what we had just talked about on the breakouts. We want to see wide bands, right? We want to see a price falling back inside of our Bollinger Bands. And again, we could look at some other technical analysis. In other words, failed breakouts on our ATR basis or candles that represent. So I kind of went through this, a lot of these candidates. Not a lot of great candidates, but I think you would agree with me on this one here is, right, our bands have exploded outwards, right? We had a nice big explosive candle outside. Now we get one candle that is, the whole candle is outside. That could be an exhaustion clue for us. The key now for us is, do we get a closing candle or closing bar that falls back inside our Bollinger Band? And right now we're right there. So this could be a good candidate. So how do we do this one in terms of our option selection? So what we're going to do is we're going to assume that price is now going to fall back this way, or that volatility is going to come out of this market, that it's going to come and settle in somewheres in between the outer band and the mean. That's all we want, right? We want volatility to either come out or we see a little directional price movement. So again, if I'm aggressive, I'm going to look at strikes that are on the Bollinger Band or slightly inside. If I'm conservative, I'm going to be outside the Bollinger Bands to look for those spread combinations. Now for mean reversions, how do we define our opposing leg in terms of our credit spread? Remember our debit spread, we say, well, let's use the whole bandwidth to help us find a target. But in this one, we want to manage our risk. So one of the ways we're going to manage our risk is we're going to look at the width of the band from the mean to the outer band. In this case, it's about $90. So we want to keep our risk in that range, $90 or less. So again, let's look at this from where current price is. We're right around 870. Our most recent high is 880. And our bandwidth here from mean to outer band is about, looks like about $85, $90, $85, $90. A little bit, $80. Yeah, there we go. Okay. All right. So let's go back to, all right, so we're looking at bull put credit spreads. We're going to sell a put, excuse me, bull bear call credit spreads. I think I told Gene I was going to do that today. All right. So aggressive, right? $870, right? There's $80, $870 versus $950, right? I'm going to take in $20 worth of premium and risk almost $60 in potential loss. Now, notice here that, again, this is where I'm being aggressive, where it's my net delta, right? It's actually outside of that 35. So, you're really taking on a lot of risk here. But, and then look at your loss probability, greater than 1/3. But let's be that conservative trader, right? We want to be outside of current price. We want to be outside of the most recent high. Well, look at this one here. Here's the 900, 950, right? Again, 950 being the upper end of the range. Here where we can see is, yeah, we're only going to get $8.60 of credit versus that risk, potential risk, if this stock goes all the way up to $950 of $41. And notice that my delta here is that 20, right? What we said is if we're doing credit spreads and conservative, we want to start looking for that delta below 20, right? In this case, that net delta is below 20, and the loss probability, right? About 1 in 4 chances that, or in other words, 3 out of 4 chances that this event is not going to happen. So this would be more of a conservative trade. Now, one of the things you can do, and I forgot to show you this in terms of the directional spread, the bull one, is, you can come in here and you can look at your risk analysis here, but look at their expected moves. And notice that for the timeline that we picked here, the expected move says that even if the market continues to move, the market price volatility, pricing and volatility where the expected move is only $910, $911. So this is a good sign that this strike combination is a good strike combination, because if we get a 100% expected move, we're just getting to our lower strike. All right. Okay. All right. So I run a little bit over on examples, but let's do one last one. And I do see a couple questions here. So let's go back to our just kind of do this real quick here. I've already picked the Bollinger Band downside reversal. These are the ones that are falling down and are going back for a mean reversion. We know we're looking at, we have our options volume. But here what I'm going to do is, again, I'm going to rank these or filter these based on a rank. Again, that implied volatility, I want to see it high. And I want to see that options availability. So again, notice here we have a lot of candidates that are 1 month rank implied volatility. And again, let's look at this from a volume standpoint. So, a couple of these could be good candidates. Again, what do we want to see? We want to see a wide width of price action. We want to see some technical analysis, right? Maybe a failed ATR breakout, oversold conditions on some technical analysis. And so, again, just before I came on, I looked at Merck, and let's look at the chart so you can kind of see what I'm looking at. Again, not a great candidate, right? Bands have, have just started to flare out. That would give me concern. I really would like to see wide bands like we see here. But what do we see in our terms of our price action? What do we talk about? Where we break out of the band, we don't get a strong breakout based on an ATR, and price returns in very quickly. So this one would be a really easy one to do. We're just going to set this up based on where current price is, and again, what is our width, our mean to our outer band is, looks like it's about $3. So what I'm going to do is I'm going to take a put right here, and then I'm going to set my spread by about that $3 risk. So naked vertical spreads. Here we're looking at bull puts, and where we go? There we go. 81. That is where we are at current price, right? 81. And that $3 differential, that band to mean, 81 to 78. And right in that net delta, right around that sweet spot that we want to look for. You know, if I want to be a lot more conservative, I could go down to the, 80, 81. Maybe I could even go deeper. Now, sometimes if you don't see the combinations you want, you can go away from show all. So for instance, let's say I want to go farther out. I want to be a lot more conservative. Well, here, here's like 79 versus 80, or 79 versus 77, right? Now our net delta is a lot lower, less probability of that trade going against us. Again, what are we picking up here? We're picking up nickels. So I like the 81, 80, 78. Again, this is not a recommendation. I'm just showing you how I'm doing that analysis, right? I'm going to pick up 60 cents versus that $2.40. I get a 1 in 3 probability that the trade is going to go against me in that net delta. I would really like to see this net delta a little bit lower, but it's in that kind of that sweet spots. All right. Okay, so let me just take a moment here, Gene, to answer a couple questions before we finish at the top of the hour here. Okay. So Brian asked, can you explain the bandwidth ATR expected move? So ATR is a measure of volatility. What we want to do is, for instance, let's go to Merck here. And what is our technical analysis, right? So our ATR here is, it's come down a little bit, but somewhere between 175 and 150. So we do 1.5 times that. That puts us around what, $2.25, $2.50. So if I go to my chart here, and I'm getting this breakout here, right? Did I get a $2.50 move? Did I get a $2.20 move outside of my Bollinger Band? Now, again, these bands are just starting to move out. That would be more of a continuation idea. But again, this analysis here is no, we did not, right? Here's our band is at 80, 81.90, and we closed at where is that, 81.15, right? We didn't get that expansion, so this would not qualify as an ATR expansion, and that's why this would probably be more likely of a failed breakout, mean reversion. So I hope that helps with that, Brian. Do you find Keltner channels helpful with Bollinger Bands? Yeah, I mean, Keltner Bands are based on a 1.5 time ATR. That's where I kind of do this analysis. So if you want to use Keltner Bands instead of using, going and doing the ATR valuation yourself, that would be a great way to do that. You can do that. Now, if you're familiar with the TTM squeeze, that is where we look at both of those. That's another webinar. So let's see. Terrence asked, how far do you can expect in a breakout from a Bollinger Band? So Terrence, Again, if we're looking at narrow bands, I will use the band width from outer band to lower band as my projected target, okay? And Kenneth, I think I kind of showed you that connection. The question is, can we expect loss probability to account for some of the other parameters? Yeah, I think that, right, that's what's nice about the loss probability, is it takes those other parameters and kind of bakes it into the pricing of our options. So good question there. All right, Gene. So that takes us to the top of the hour, folks. So let's do one more slide. And so again, remember, delta is your friend for strike selection. It's very simple, and it's very practical, and it's a good proxy for probability. And that was kind of what Kenneth was asking. Always pair Bollinger Band signals with volume and at least one momentum or trend filter. And again, the one that I personally like is ATR. Use verticals for defined risk structures if you want to be conservative. If you're aggressive, right, you can use one-legged out of the money options or short DT for aggressive plays. Monitor your implied volatility. I didn't get enough time to go into this. So particularly, let's say those downside reversals where we might not have a lot of volatility baked into it. So if we have low volatility, what is our strategy? Well, our strategy is we want to buy volatility, right? So if I can find a downside reversal, in other words, a stock that's gone below the lower Bollinger Band and has now moved back in, but I look at it from a larger perspective. In other words, this stock has been either in a range or is actually been trending higher. Well, why couldn't I use that as an opportunity to do a vertical bull spread, right? In other words, I will buy the strike that is on the lower Bollinger Band, and then I would set my target at the mean. And that would be based on the volatility. So, question, this is what you're going to do. Do I sell expensive options and harvest high implied volatility premiums, or do I buy defined risk options, directional bets with low implied volatility costs? And that was kind of the example I was giving you. All right, folks, I hope you guys enjoyed today's show. Really get a chance to test drive this new page. I think there's a lot of great information in here. You're going to find a lot of great candidates. Next week, we're going to go do something a little bit different. I'm going to give you my 3 favorite screeners, Barchart screeners that we have that I use. Now, I tweak them a little bit, but you can read the description here. We're going to look at my 3 favorite screeners and how I use them to find trading ideas. Okay. Again, for those who've stuck around, if you go into archive webinars, you can see today's Bollinger Bands. And if I open that up, there is the slides where you can find that little map. All right. I see a couple of nice comments from Dorothy and Wayne. Thanks, guys. I appreciate it. Until next time, manage your risk, the best of health, and the good of all trading.